Thanks for tuning into today's Talking Point. I'm Niraj Shah, and the case for a chat today with our guest Ashwini Agarwal is multifold. There has been a one-way rally of sorts in the market. Could there be volatility ahead, or will we continue to see a stable ascent? So that's part one of my questioning to him. Where is it that there are relatively comfortable valuations existing, coupled with some growth? I think we'll try and talk about that as well with him. And of course, if indeed flows are to come back, if you can make a thesis around flows coming back into India, will the ones which have suffered the most from that, which is private banks, again make a bit of a comeback? It's very important for the bank nifty markets at large for private banks to start doing well again on the bourses, and that can happen with flows, which can possibly happen only with global flows. So I think in some sense we'll try and talk to Ashwini about that as well. He's the founder of Demeter Advisors and joins us right now on the show. Ashwini, good having you. Thanks for taking the time out. Hope all is well.
Morning, Niraj. Thank you. All is well.
Ashwini, a lot of chatter around how the Indian valuations defy, in some sense, what's happening across the world on the growth front, even if India were to be growing well. I'm trying to understand, are you okay with the kind of moves that we've made index-wide, though the last 2 months we've been largely flatlining? And what's the way ahead, therefore? Would we continue to flatline? Could we see an ascent in the run-up to the elections? And would that be something that would make you uncomfortable?
So, Niraj, two important points here. Like you said, the growth globally has been slowing down. And the second macro reality is that with the expectations of very sharp interest rate cuts that we had, let's say around September, October last year, have now been pushed out. Even in the Indian context, I mean, there's been no cut in rates. And if you read through the RBI policy, it appears that there may be no development on this front for at least the next 3 or 4 months or post-elections. We might see something not right away. And it's similar trajectory for rates, at least in the US. So the question I'm asking myself is that if you look at growth, is the growth accelerating? And I'm talking about real GDP growth here, or is the growth stable, or is the growth slowing down? In the Indian context, I think we saw very strong growth in the first half of the current fiscal year, which is the period April to September 23, and now we are starting to see the base period catch up. I think growth should be stable around 6 to 6.5% over the next one financial year or so. And there is no acceleration visible yet, despite significant push by the government on infrastructure spending, especially in the areas of defense, railways, and so on. So my sense is that, with earnings growth of the order of maybe about 14-15%, slightly ahead of nominal GDP growth, the market is already pricing in a significant amount of near-term earnings upside. So to answer your question that, do we see a continued, moves upward from here on an index-wide basis? I think that's a tall order. Within the emerging market space, if you were to look at it, and I know several people keep saying that asset class is dead, India is a really expensive outlier. So notwithstanding the diversity of the Indian market, notwithstanding the growth, I think a lot of good news is priced in. That's what I see from a global perspective looking into India. However, if you look from within India for savers in India, what's happening is that we are hostages to our own market because of capital controls, and there is of course a home bias that every country has with its own investors. And these investors have done very well in the last 4 years, notwithstanding correction that we saw between September 22 to maybe about September 21 to about March of 23. So that was the 18-month period where we saw the markets go down. And despite that, over the last 4 years since COVID, investors have done well. So the domestic money continues to flow in, and that may prevent the market from going down a lot. So, flat lining is what we've seen over the last 2 or 3 months, and that might continue, notwithstanding my concern on valuation.
Okay, so in some sense, Ashwini, you are saying that the going seems to be, and correct me if I'm wrong, but the
Yeah.
going seems to be so, there's to be so much of interest that despite the higher valuations, we may still flatline and not correct because there is an appetite at every dip.
That's correct. If you look at the local flows that are coming into mutual funds and direct money that's coming into the market, that may not allow the market to sink a lot. But valuations have their own way of imposing themselves on the market. If you go back to again September 21, and we saw a plethora of IPOs, then the new age. Internet-based companies. Their valuations were very expensive for traditional investors like me who've been around for a while and have value as a constant discipline that we are trying to adhere to. And we were amazed at the kind of response that these issues got. But lo and behold, over the next 18 months, you did see a significant correction. So pockets of market where the valuations are expensive today, be that defense, be that railways, there you can see a lot of correction because I think while the stories are good in the long run, just as they were in the internet-based companies in the middle of 21, you may still see a significant price correction because valuations are completely absurd.
And viewers, I must bring out this point, and with a couple of charts maybe before I go back to Ashwini, because the point that he's making is very important. A lot of us and a lot of people who are coming to the markets in the last 4 or 5 years, which is a large percentage of my viewing population as well, at times forget this. So look at say maybe a 2-year or a 5-year chart of Zomato, or whatever time it's listed. And the stock, while it's rallied from 50 rupees all the way to 130, 140, it has corrected initially from 160, 170, whatever it is, all the way to 45. So in some sense, Zomato 12-month chart looks really impressive, right? Now expand this to 5 years, and you will see how the stock corrected quite viciously before coming up again. And maybe an even better example, look at that. And that shows you that over 3 years or something like that, you've gotten virtually no returns. That's part one. If you're invested right at the peak, at the expensive valuations. Similarly, for a behemoth like Demeter, and just look at what the stock has done. A brilliant stock. Everybody shops from there, from the stores, but it's virtually flatlined in a minuscule way for the last so much of a long period of time. Ashwini, I'm inclined to ask you, since you've been around, as you said, for such a long time. Private banks, now they are performing fundamentally. The issue has been that the supply from the FPIs has been large. What would it take to turn the fortunes of these banks around? Would it need to come from FII flows for these stocks to start performing?
Yes. But the simple answer is yes. I mean, it's a little bit of a circular logic. But what happens is that the domestic investors, when I'm talking about the large behemoth of the large body of retail investors, they tend to take price momentum into account. And I'm not looking down upon price momentum as a strategy. I mean, one of the best explanatory factors for a single stock performance is actually momentum if you do factor analysis over a long period of time. So momentum is the way a lot of people invest, and that's fine. And for the momentum to change in private equity, in private sector banks, you will need foreign interest to come back because these are very significantly owned by foreign investors. There are very large, these are very large free float companies. So unless there is a significant shift in institutional buying for private sector banks, it's difficult to see how the price momentum will change. Having said that, I'd like to draw a parallel here between what you just spoke about on Zomato and on DMart, and I don't own those stocks. I don't usually talk about specific names, but here I'll take the liberty of using a few names. HDFC Bank, a position that I own, Kotak Mahindra Bank, a position I don't own. If you look at these names, they were very expensive towards the end of, let's say, 2019, because we were coming out of a decade of highly stressed bank balance sheets, and these two banks managed to keep their balance sheets very, very clean. As Mr. Kotak has always has often said that there was a cleanest shirt in a dirty laundry basket. So the valuations for them were very high. And why I'm linking this to your Zomato comment or your DMart comment is that valuations are very important at the point of investing, because you may buy a great company, but if you just pay too much for it at the time of going in, you might be stuck with no returns for a period of 3 to 5 years. And that's exactly what has happened to some of the private sector banks. And Niraj, you spoke about private sector banks as a body, but I don't think that's true for all the private sector banks. I mean, if you look at some of the other names within the private sector, they've done very well over the last 3 years or even 5 years, dare I say. Um, it's the two or three names that had become ridiculously expensive that have failed to perform for the reasons that valuations have finally caught up with them. And I think in the case of HDFC Bank, again, to reiterate, it's a position that I own, it is facing the merger related challenges and might take some time to sort itself out. But I think if we were to look at a 3 or a 5 year picture, I think, this might actually not be such a bad time to invest into them. But of course, the momentum has to return.
Okay, fair point. And yes, I stand corrected. It's not that the whole body is not done well. There are some exceptions to the rule as well. Just that everybody gets caught up in the commentary around HDFC Bank, Kotak Bank, and the likes. Maybe even an ICICI Bank in the recent past, if you will. Okay, so that's one. The other interesting study, Ashwini, that was done by Bernstein, that PSU stocks, which have again for the month of February kind of gone completely quiet after a breakneck rally for the last few months. And their ownership analysis seemed to suggest that FPIs have largely avoided this pocket. It's largely been retail DII investors which took this space higher. Now it's flatlining because of expensive valuations, save for maybe PSU banks. And difficult to assess as to what happens there. But the ownership analysis was interesting. So my question to you is, because domestic flows continue to remain strong, but the flows are managed by very smart mutual fund managers, if you will, do PSUs as a body, because of the valuations, largely stay flatline for the next few months until earnings catch up?
I would think so selectively, because some of the PSU stocks, if you were to draw long-term price to earnings or price to book charts for several of these PSU names, they are now trading pretty much at the upper end of the valuation range. And this includes the period of 2006 to 2008, which is when these stocks had done phenomenally well. So I think valuations are now pretty full. But these companies are doing well because the way the administration has kind of turned around, in the sense that from what we hear, there is not that much interference from the government in the independent running of these PSUs, and some of them are pretty well run. But I think the valuations are now expensive in several pockets, and they might take some time to catch up. I think the PSU banks, there are still some selective pockets where valuations are not very expensive, but again, in the historical context, they've always traded at a discount to private sector banks, and I think there is good reason why that's the case, and that I don't see that going away. So yes, my sense is that PSU stocks are also pretty fully priced at this point.
Ashwini, I was trying to understand, therefore, in such a scenario, what looks attractive enough to invest in, aside of maybe say select private banks wherein there might be opportunity? What is it that is looking attractive?
So, Niraj, if you look at a lot of the chemicals space, right? It was hugely in favor immediately post COVID. Prices for a lot of base chemicals went up a lot, and they made humongous margin gains. And over the last 12 months, all those margins have been given up, even though stock prices haven't given up all their gains, but they've given a substantial part of their gains. But the core story hasn't changed, in the sense that China plus one is still a reality. I think globally, outsourcing is moving to India. We are getting a lot of attention for being in the space that we are as a stable country, and so on and so forth. And in addition to the fact that China also wants to vacate the space where value addition is lower from their perspective, where they're focusing more on electronics and cars and EVs and battery technologies and so on. So I think in base chemicals, I think where uh, prices were down significantly because of excess inventory built up immediately post COVID. I think you're finally starting to see an end to that inventory cycle. And I think margins will normalize, growth will come back. So that's one space that I'm quite excited about. Pharmaceuticals, I continue to be fairly excited about. I think here again, the generic pricing environment is a lot better is a lot better today than it has been in the last 3 or 4 years, and demand is also pretty decent both in India as well as overseas. So I think that's another space that I'm looking at quite favorably, especially the generics space. I think in several exporters, smaller companies, the China Plus One narrative is real. There's a huge opportunity for them to win market share on a global basis. And if you have companies which are well managed with good balance sheets, new capacities in place, I think you'll be surprised by the kind of earnings growth that will come through over the next 2 to 3 years. And the Indian market always rewards earnings growth. So if there's a company that's growing at 20-25% compounded annual for the next 2 to 3 years, you should always expect the valuations to go bananas at some point. So I think those are some of the spaces that are looking quite interesting. I think as a defensive trade, I would say consumer staples in India and IT services are both places where you're likely to lose less in case the market goes into a correction. I mean, these are not fancied places to be for obvious reasons, but I think valuations are reasonable. There is good, management in place. Cash flows are very, very strong. So I think, on a relative basis, these are places to hide.
Are you defensive in your portfolio? Have you added these names for that particular virtue?
So, Neeraj, not IT services, but I
Okay.
have added a couple of consumer names because I do think that rural consumer demand should come back because the inflationary shock that has hurt the demand over the last 12 to 18 months is now beginning to fade. So I'm hopeful of that outcome. But I have turned defensive in my portfolio allocation in the sense that I'm sitting on about 15% cash, which is not normally the case. So,
Uh,
so if that reflects my view on the market, that's something that I'd like to share with your viewers.
yeah, thank you. But so viewers, the other point is IT is good, but Ashwini is still sitting on cash as opposed to deploying that money into IT names. So maybe clarity from the companies at some point of time around turn of discretionary demand. Maybe that is a factor, but yeah, certainly a pocket to focus on. Now, a couple of questions, Ashwini, follow-ups to your first answer, which is pharmaceuticals, for example. If I look at the last 3, 6, 9, 12 months performance, at any point of time you bought into any of the generic names, Sun Pharma, Dr. Reddy's, Lupin, etc. Lupin has been a poster boy, but the others too, you've made money. So these stocks have rallied. It's not like they've stayed quiet in the last 12 months. You still reckon that there is value in investing in them?
I mean, the value is less than what it was 12 months ago for sure. But I think they're not expensive. They're reasonably priced and the earnings growth is strong. So, if you're looking at the whole market, which is expensive, you go into spaces where valuations are reasonable and earnings is decent. So, it's not like 2015, 2016. If you remember, 2016, there was a cover story when Sun Pharma's market cap briefly had eclipsed that of Reliance Industries. The valuations were nuts back then. So it's nowhere close to that. I mean, valuations are okay; they're fine. I mean, they're in their 20s. The earnings growth story is pretty solid for some of them. Larger companies, especially, there are differentiated portfolios that they've been able to create. So these are not pure run-of-the-mill generic companies anymore. They are also significantly competitive at what they do. Similarly, in the upstream chemicals and the downstream chemical space, I think there are niche products that companies have been able to build. I think one of the things that we underestimate is the amount of confidence in Indians in general have. So people don't shy away from investing in R&D with uncertain outcomes, as used to be the case 10 or 15 years ago, and that's starting to pay off.
Oh, that's true. I mean, we've seen so many pharma companies, even in the CDMO space, talk about
Yes.
making large investments with the returns not being necessarily coming in the next 12 to 24 months, but building out for the longer term. Which is so
That's
very well
right.
put. Thanks, Ashwini. I have one final question. Your conversation with us on Insight, when we spoke about a particular real estate name, evoked a lot of responses to our social media team and our handles. I'm trying to understand. Are you constructive on real estate per se as a pocket? We had spoken back then about Max Estates. Was it a particular bottom-up idea, or are you still constructive on Max and the real estate space at large?
Okay, so first, due disclosure, I am a shareholder in Max Estates. So that's something that your viewers should know. Second is, I am constructive about real estate. Okay, real estate has long cycles. At least that's what I've experienced. And typically, the real estate cycles start 1 or 2 years after a bull market has set in, and they continue for much longer than typical bull market cycles in the equity market. A better home is a universal desire. And when people make money, be it by way of ESOPs, be it by way of investments, smart investments made by them in the market, by way of listing companies and benefiting from them, as has been the case for several promoters, both on the SME as well as small and mid-sized companies on main bourses. The desire to buy a good home is a universal desire. And I think real estate will continue to do very well for the next 5, 7 years. Uh, Picking stocks in this space is very difficult because these are long gestation projects, and very often, balance sheets get into trouble, projects get into trouble because of regulatory difficulties they face. So, on a bottom-up basis, I have historically found it very difficult to find companies. And Max Estates, about a year and a half or so ago, or maybe 2 years ago, when I first looked at it, looked reasonably appealing from that standpoint, from the kind of governance checks and balances they put into place. And it's a unique company in the sense that it has a large portfolio of rented properties that bring in regular income, and a developmental portfolio and a development portfolio as well. With a very strong discipline around balance sheet, so it's a bit of a unique story, and that's the only real estate play I own. But I'm positive on the space, except that I'm wary of investing in individual stocks for the reasons I outlined.
Got it. Ashwini, so good talking to you today. Thanks for joining us and giving us your thoughts on a variety of issues. Have a great trip as you're heading out tomorrow. Looking forward to talk to you soon.
Thank you. Thank you, Niraj. Have a nice day.
You too. And viewers, thanks for tuning into this edition of The Talking Point.